All right, hi everyone. Welcome to Smart About Money. This presentation is going to be about banking and credit.
My name is Ben. I'm a peer financial coach.
And I'm Hallie. I'm also a peer financial coach. So we're obviously Smart About Money. It is a peer financial coaching program through Student Success at UMass. We offer one-on-one peer financial coaching sessions. Right now this semester and next semester they are on Zoom so that everything is virtual. We also do presentations and workshops with clubs and classes. And when we are on campus, we usually have events like Family Feud, De-Stress Fest, and Cash Cab. So definitely keep an eye out for that once we go back to campus. And then in the bottom right corner here, you see all of our contact information. So you can follow us on Instagram and Facebook, and always feel free to check out our website or send us an email.
Today, we're going to go through a couple of learning objectives. The first is understanding the different types of basic accounts and features that are offered by banks and credit unions. Second, we're going to be analyzing the different accounts and features and protections that allow students to become more knowledgeable about their finances. We're going to be understanding the factors that impact your credit score, as well as some of the common fees and features of different accounts. So to start off, we're going to be talking about credit. Credit is one of probably the pillars of personal finance, just because of how often it impacts your life. So we're going to start off with what is credit. Credit is your worthiness to receive money based off of your likelihood to pay back the loan with interest. You're going to build up your credit or that sort of trust from the lender by paying back all different types of loans, either student loans or credit cards or CSA farm shares or any sort of loan that you're paying back and it is reported to a credit bureau. It will build up your credit score over time based off of the factors we're going to go over in a little bit. Your score is based on a scale out of 850, and there are 5 factors. There's also ranges from poor to exceptional. This is an example of that range. Depending on your loan provider, they may have a slightly different one, but this is sort of a general guideline of what you want to achieve. You want to be typically above a 650, but here good 670. So it's a little flexible, and it really depends on who you're taking your loan from. Why you should have good credit. You may not be encountering a lot of these factors yet, but you're going to later on when you graduate or when you start having to make financing decisions on your own. Renting an apartment is the biggest one. From personal experience, I know dozens of landlords that the first thing they do is check credit. Because every month is technically a small loan, you are really just borrowing them on a revolving basis month after month. And so they really want to make sure you have a good history of that. On a different note, things like higher interest payments or qualifying for credit cards. In those circumstances, your credit worthiness is based off how risky you are as a borrower. As we said earlier, with your worthiness is based off of your history of making payments. It's also based off of your risk of not making payments. And so a bank will look at you if you have a poor credit score, having a poor payment history, and think of you as more risky. That risk is associated with your interest rate. And so if you're more risky, you're going to have a higher interest rate compared to someone who is less risky, and they're going to have a lower interest rate. There's also things like car insurance premiums, utility down payments, mortgage interest, and even getting a phone, all require good credit. How is your credit score determined? So there are 5 factors that impact your credit score: your payment history, the amount owed, the amount of the number of times you're applying for new credit, the length of an average of your credit history, along with the credit mix. How is your credit score determined in your payment history category? under payment history, it's whether or not are your payments on time. So are you making your payments every month? Are you paying at least the minimum? Those are sorts of things that they keep you in good standing with your creditor. Amounts owed is also known as the credit utilization ratio, or the ratio of the amount owed to your limit. For example, if you had $1,000 credit limit on a credit card, your utilization ratio would be, if you only spent $300, your ratio would be 30%. That 30% is very important because that's the mark where you want to stay under. So you want to be under the $300 if you had the $1,000 credit limit in order to positively impact your score to the fullest. Next up is length of credit history. This works in two ways. One, the length, how long you've had your oldest revolving credit or your longest standard credit, and your average length of credit for all of your loans. Typically, they want to see a more mature borrower, so that's like 5 years or so. If you don't have that, that's fine. The longer you have your credit out there, the more it'll improve over time. That's why a lot of college students aren't able to achieve an 850, just because they don't have that length of time in order to really accumulate yet. Next up is credit mix, like the different types of credit that you have. For example, student loans, credit cards, mortgage payments, auto loans, revolving credits. Those sorts of things are all different parts of the credit mix, and the more you have, you may get a little bump in your score because of it. Next up is how often you've applied for new credit. Going back to how risky you are, if you're applying for 5 or 6 different cards at the same time, it's going to look like you're pretty desperate for that credit, and you're going to be less likely to pay it back. So try opening up 1 or maybe 2 at a time over the course of a couple months, trying to spread it out a little bit, just because it's going to make you look a little worse, and it will help your credit score over time.
That was a brief overview of credit, and now we'll talk a little bit about banking and banking institutions. So to start, we can talk a little bit about banks versus credit unions. You've probably all heard about banks and credit unions, and there are some significant differences between the two. So first, banks are owned by the shareholders and investors, so they operate for profit, which means that a lot of their interest rates and motivations are driven by making a profit. They can range from small banks to very large commercial banks, and they offer a plethora of services, everything from mobile banking to normal banking services like savings and checking accounts. You can get a lot of different things through banks, and they usually have higher fees and service charges because, again, they are for-profit institutions. And so with that, they have lower interest rates on savings accounts and higher rates on loans because they're looking to make that profit off any services that they offer. In contrast, credit unions are often thought of as being very small, and they can be small local credit unions, but there also are larger credit unions that operate throughout the country. And a big difference here is that credit unions are owned and operated by the members of the credit union. So as opposed to banks being operated by investors, credit unions are owned by the members and invest in their members. And so they're considered nonprofits, and they can offer lower rates on borrowing and higher rates on savings accounts. And a lot of times people think that with credit unions, there aren't as many services available, but a lot of credit unions either have mobile banking like banks, even though they might not be as advanced, but credit unions can also have co-op programs that allow you to use ATMs and banking features of other credit unions across the country. So if you're a member of the 5 College Credit Union, you can still use an ATM when you're out in California or something like that.
So now we're going to go into the different types of accounts. First up is the traditional savings account. Many people already have traditional savings accounts that they were opened as a kid, or that their parents opened for them at some point. And this is just the basic, put your money in the bank, have a small interest rate. It doesn't really have any fees attached to it. And it sits there and grows a little over time. Traditional savings accounts, along with the other savings accounts, are great ways to hold what's called an emergency fund, or your 3 to 6 months of expenses that you can save for times of emergency or need. High yield accounts typically have a little bit higher interest rate than the traditional savings account, so you're going to earn a little bit more money back quicker. The difference is high yield accounts tend to have different minimums, account minimums, and average balance minimums than the traditional savings, which don't usually have those restrictions. Money market has again a little bit higher interest rate than the traditional savings account. But again, it has a different sort of minimum fee standard structure, and it fluctuates its interest rate a little bit more. Then there are some specialty savings accounts like the Holiday Club or a health savings account or an HSA. In the Holiday Club, you're pretty much saving towards like holiday gifts. And so the account is intended to not be open for an extended period of time. It's only supposed to be open until typically November, early December, when you liquidate the account and spend all the money. Holiday accounts can also be transferred into traditional savings accounts, just because the traditional savings accounts don't really have too many benefits. The HSA is primarily for medical expenses, and so you're able to use it for medical purposes, and it has some special tax implications that if you come in for an appointment, we can go through further. Almost all savings accounts are subject to what's called Regulation D. Regulation D is to avoid money laundering and fraud internationally, and it's to avoid using savings accounts as a pass-through to withdraw and deposit money frequently. It's not what savings accounts are intended for. Savings accounts are particularly intended for savings. That's why they're named that. And so you're not really supposed to be withdrawing more than a couple times a month. That's what it's intended for. So Regulation D says you can't withdraw electronically more than 6 times a month. You're able to avoid this regulation by going into a branch or an ATM, and deposits don't count towards the 6 electronic withdrawals because they're deposits. But it's important to recognize that if you're looking to use Venmo or PayPal or any sort of electronic transfer, you don't do that more than 6 times a month out of your account. Next up, we got checking. There's a couple types of checking accounts. You got the standard, the high yield, and the rewards. Standard, you use, a lot of people use with their debit card, and it's intended to have money come in and out frequently. And so there's not typically rewards based off of that, and it's similar to a traditional savings account, except it doesn't have the interest rate attached to it. High yield, similar to a high yield savings account in that you're starting to earn interest on your checking account, but they tend to have account minimums and making sure you have an average daily balance of a certain amount. Rewards accounts, most banks and credit unions have rewards accounts that offer either cash back or discounts at certain stores based off of if you spend money in a certain time period with that checking account. Most checking accounts are linked to a debit card, so you're able to use it almost as a credit card, but you're not necessarily getting the benefit of making payments to increase your credit score.
So next we'll talk about some services that are commonly offered by banking institutions. So overdraft is a really important term to know. Basically, you can incur overdraft fees if you withdraw more funds than you have in your account at the time. So it's split into two parts. Overdraft protection is when your banking institution allows you to connect another one of your accounts, like your saving account or credit card, to your checking account. So if you ever do need to withdraw more funds than you have in your checking account, the excess will be withdrawn from your savings or credit card to cover that balance. And this helps to make sure that the money being taken out isn't rejected because you don't have sufficient funds. If you don't have overdraft protection, overdraft payment is a little bit more complicated. And with overdraft payment, institutions will cover any extra funds that are taken out of your account beyond what you have. But this is given as a loan to you. So basically, if you have $10 in your account and you withdraw 15, then your banking institution would cover the extra $5, but you have to pay that $5 back. And then on top of that, when you have overdraft payment, you'll incur an overdraft fee, which can be as high as like $30 to $40. So you definitely want to be sure that you have sufficient funds in your account so that you're not incurring these fees. And you can also look over your institution's payment terms to see if they're charging interest on those balances that you withdraw and whether you can opt in or opt out of overdraft payment. So overdraft protection, that's usually a much smaller fee, maybe $5 to $10, or some institutions don't even offer a fee at all. So definitely try and opt into overdraft protection before overdraft payment. In terms of moving money, a lot of banks offer what are called electronic funds transfers, or EFTs. So that's more commonly known as electronic banking. And that's a way to transfer money from one institution, one bank account to another. And the accounts don't have to be at the same institution, but they can be. Probably the most common type of EFT is an ACH, or automated clearinghouse payment. And the automated clearinghouse connects all financial institutions in the US and can be used to transfer funds from one bank to another. And there's ACH debit and ACH credit, where ACH debit transfers allow you to authorize someone to pull money from your account. And this can be a recurring payment for a subscription service. So anything that you pay for monthly like that might be an ACH debit. ACH credit transfers are when you push funds out of your account, so sending money to a friend or family member. And typically ACH debit transfers are free, but some banks may charge a small fee for ACH credit transfers. But one of the most common types of transfers is a direct deposit. So if you're getting a direct deposit from the place that you work, that's an example of an ACH transfer. And again, most of these services are free, as opposed to services like PayPal or Venmo, which might charge you fees to transfer funds from your bank account to another. So there are a lot of fees associated with opening and maintaining accounts at banks, and it's important to check with your banking institution to understand which fees might apply. Some banks offer a fee waiver to students. So while you're in school, you might not have to pay a minimum balance or monthly maintenance fee, but you definitely want to know whether your institution is offering this, because as soon as you're out of school, you'll have to start paying those fees if you don't meet the requirements. So a common fee is a monthly maintenance fee, which is applied when accounts don't meet a certain conditions set by the bank. And then minimum balances are basically a bank stipulates that you have to have a certain amount of money in your account. And if you don't have that amount, or if you dip below that amount, the bank will charge you a fee of $5 to $10 just to kind of encourage you to keep that amount in your account. So you definitely want to check with your bank and the terms of your account to see what those fee structures are and make sure that you can meet them. And this is a place where you want to compare different banking accounts if you're looking to open an account at a bank, and make sure that the monthly balances and monthly maintenance fees are something that you can meet and that fits with your savings goals. Some other common fees
Oh,
are late charges. So this applies to credit card accounts. This is a fee for missing the minimum payment on a credit card before the deadline. And they can range from $25 to $40. So it's really important to try and make at least the minimum payment each statement period. We definitely recommend you make the full payment, but making at least the minimum payment will help you avoid any late fees. And there is a grace period between the time of your statement date and your due date, and any payments made within that date will help you to avoid late fees. So a lot of banks allow you to miss one payment before a late fee is incurred, but you definitely don't want to use that as a fallback. You should know what your banking institution rules are on late fees and try to make the payments before your due date. Late payments can also harm your credit score. So like Ben had said earlier, your payment history is the biggest part of your credit score. So any late payments are going to decrease your credit score, and you want to make sure that you're making those payments on time. But late payments do take 30 days to be reported to the credit bureau. So if you can make up a missed payment within that 30 days, you can stop the late payment from being reported to the credit bureau.
Protection and insurance. So banks are insured by the FDIC up to $250,000 per depositor for an individual and $500,000 per couple. This is for all accounts, not just one. So if you had 3 accounts, the total insurance is up to $250,000. Credit unions are similarly insured by the NCUA up to $250,000. It's important that your bank has, most do, if you're using any sort of reputable bank or credit union, even your local ones will have this sort of registered insurance, but it's important to check before you open an account and make sure that they have it. This protection is to ensure that if the bank goes under or isn't able to meet you aren't able to withdraw your money, that your money is there. It's protected by the federal government up to that $250,000 limit. And the final question, should you ditch your hometown bank? This is a really personal question, and it really does depend. It's important to ask yourself what your current banking needs are, and does it make sense to switch? There are credit unions for every person, and there are banks for every person. Some banks and credit unions offer great customer service, and that's what you really care about. Some have frequent ATMs everywhere, and you don't need to worry about having refunds for ATM fees. Some offer low fees, some offer high yields. It's really what you're looking for. If you're looking for the biggest yield possible, that's what you're going to look for, whether or not that's a bank or a credit union. And so that's the first thing that you need to ask yourself is what do I need from a bank? Accessibility, co-op shared branching, ATM fees, and refunds. Those are all things to make sure you consider on whether or not you should leave your bank or not. If your hometown bank, for example, doesn't offer ATM reimbursement, you may want to consider opening an account if you're moving to a new area, if you're not able to collect the fees back and you're not able to get back home to withdraw money from your checking account. But again, it's a really personal question, and it's something that we can go over with you if you sign up for an appointment on Navigate.
right.
Thank you for coming. We hope you learned a lot. Follow us on Instagram or Facebook and visit our website at umass.edu/student success.
Yeah, and definitely always feel free to reach out on any of those platforms or make an appointment through Navigate. Just go to Peer Financial Services and you can book an appointment with any of us. Thank you.